Hey everyone, this is Mark Treichel with another episode of With Flying Colors. Today I'm flying solo and we'll be discussing NCUA's proposed rule to eliminate reputation risk. A little bit of background. Previously, NCUA chairman had come out with a press release that they were going to be getting rid of reputation risk. Then they sent out an email to all CEOs from the Office of Examination of Insurance indicating they were getting rid of all risk ratings. And then October 20th, just yesterday, they came out with a proposed rulemaking to take further action to solidify removal of use of reputation risk. And I'm going to walk through what that proposed rule goes into and then give you a little bit of my take on what it means and what it does not mean. All right. So as I stated, NCUA is proposing a rule that says we will be creating the elimination of reputation risk. They're formally proposing to codify the removal of reputation risk from its supervisory program. Examiners will no longer be able to cite it in reports, use it in ratings, or base supervisory actions on it. So they've already done that. They're codifying it. Codifying, what does that mean? That means they're putting it in regulation. To me, the biggest corollary here would be succession planning, which they had previously not handled, and then they handled it via a letter to credit unions, and then under the Harper-led board, they put it out as a proposal to a regulation, and then they approved that regulation. So once it's codified, once it's in the regulations, or the regs, as we like to say, it takes a board action to unwind that. My instinct is that the Trump administration is asking all the banking regulators to codify this so that that bell has been rung and it would have to be unrung at the politician and board level at any agency instead of someone coming in and saying, hey, we're going to change this policy and having it done at a staff level. Makes it harder to take it out. That's what codifying does. All right, number two, why reputation according to NCUA? Reputation risk is problematic. It's subjective and hard to measure. I'll give them that. Leads to examiner inconsistency, unpredictability, and potential bias. I think that's a stretch. It distracts both examiners and credit unions from managing real measurable risks. I'm not sure I agree with that either. Let's go back to it's subjective and hard to measure. Sure. So is unsafe and unsound. And I'm going to get into a proposal on another podcast on another day in another week about the federal regulators and other agencies coming out with a proposed definition of safe and sound, which I believe NCUA would probably follow up if they get to that. But what's safe and sound? What is safe and sound? What's beauty? What's reputation risk? Yes, they're all subjective and hard to measure, but reputation risk is not the only hard to measure thing that NCUA and other regulators have to deal with. They're doing this because they think reputation risk was misused in the past, and I'll get into that. So in the proposal, there is explicit reference to political reasons. The proposed rule is clear that NCUA cannot act for political reasons. Now, if you asked every employee at NCUA if they believed they could not act for political reasons, they would say, of course not, we don't act for political reasons. Doesn't get it into unconscious bias and all that, but do NCUA staff believe they do that? I would bet dollars to donuts that they don't believe they do it. The examiners cannot pressure a credit union to deny or close accounts based on political beefs or lawful or unpopular activities. I would bet, again, that's never happened in any NCUA examinations. There were situations in other types of financial institutions where this was alleged as having happened recently and then under President Trump's first term. So there is an alignment here with the White House. And again, we have a board of one at NCUA, one Republican, and they're trying to carry the water of the White House because that's what they do, right? No criticism here. It's just the reality of the agencies are going to move in the direction of whoever's in the White House. So the proposal directly aligns with President Trump's executive order 14331. Guaranteeing fair banking for all Americans. The goal is to prevent regulators from using reputation risk as a pretext to cut off lawful financial services. Now, in the past, there was Operation Choke Point, where allegedly individuals who had gun stores had their accounts closed. And then there was the pillow guy, can't think of his name, who had his businesses allegedly shut down for the wrong reasons. And again, I'm not going into the facts of whether that happened or that didn't happen, but that's the argument. Now, there are allegations of politically driven account closures. President Trump has argued that banks and credit unions have closed accounts of Republicans and conservative groups, citing reputation risk. I don't think he's actually named credit unions. So let me clarify that. I believe he's said that banks have, not credit unions. Now, whether proven or not, the perception was that lawful but disfavored groups were being punished. Again, that's the perception. And in making this rule, they're saying it's the reality. Now, some generic examples of at-risk groups: political campaigns or advocacy groups, faith-based, nonprofits with controversial positions, lawful but politically sensitive industries like firearms, as I mentioned, payday lending, or medical marijuana. So those are areas that they highlight as possibly being impacted for reputation risk citations in examinations. There's a focus on, they want examiners to focus on real risks instead. So that's credit risk, liquidity risk, interest rate risk, cybersecurity, operational risks are measurable and belong exams, as opposed to reputation risk, which do not, according to this proposal. Again, reputation risk adds little value to safety and soundness oversight, according to the proposed rule. Now, credit unions, the other takeaway from the rule is that credit unions know their members best. Management, not regulators, should decide how member perception affects strategies. Examiners are not equipped to measure public opinion or member trust. I would agree with that. So what are the prohibited examiner actions under the proposed rule? Under this rule, examiners cannot require a credit union to close accounts, cannot discourage offering services, cannot terminate vendor or third-party contracts, cannot pressure credit unions to avoid lawful businesses. Again, if you asked your examiner, do you do any of those things? Have you ever done any of those things in your 10, 20, 30 years as an examiner? They would say no, wouldn't even contemplate it. But this codifies it. Again, it puts it in the law. So there's a broad definition of adverse action, which includes exam downgrades, negative feedback, denial of applications, or even informal supervisory pressure. Any examiner action designed to punish or steer a credit union based on reputation is off limits. Now, what about state regulators? What's the context as it relates to state regulators? State examiners may still apply a reputation risk if they choose, but NCUA examiners must not participate or enforce in that discussion or that being brought up in an examination where it's a joint examination where NCUA is there, or if NCUA in your state does solo examinations, they won't touch that because, again, this proposed rule, when final, will make it on a third rail, if you will. So it's a wide scope of doing business with. In the proposal, it goes beyond accounts. It covers vendor contracts, employment decisions, and even charitable giving. It ensures that there are no backdoors ways for regulators to influence credit union relationships. Well, that would be the goal, because there are no absolutes in life, but that's their goal. So it's already in effect, because on September 25th, NCUA told staff and credit unions that reputation risk would no longer be used. The rule simply cements that policy into law. And again, why into law? Why codify it? Because it has to be changed by the NCUA board going forward. Again, presuming that it's approved by the board. And since it was proposed by a board of one, you can bet your bottom dollar that it will be approved by a board of one, or if Trump puts new board members in, it will be voted on that. I guess theoretically, the one way it wouldn't happen would be if somehow the Supreme Court would decide that Otska and Harper need to come back before it was voted on in its final form. If they did come back after they put it in place, theoretically, you could have the two Dems then unwind that rule. So what are the expected benefits? Greater objectivity and consistency in exams, more clarity for credit unions managing examiner expectations, and it protects credit unions from being dragged into political or cultural disputes. Again, those are the expected benefits from the author. You could argue that just by proposing this, they're getting pulled into the political disputes. Again, and depending on which side of the aisle you're on, or if you're not in the aisle and you're in the middle. No new compliance costs. Since reputation risk was already discontinued, this rule creates no new burden. So that's kind of funny. They discontinued it in September. They propose a rule in October and say, since we discontinued it in policy in September, there are no costs. That's a tricky way of avoiding some of the how much does this cost, and is it a major rule, and all those nuances tied to regulation making. So instead, it reduces uncertainty and increases predictability is what it proposes. Here's the thing. The NCUA proposal directly addresses a headline issue. President Trump has said that reputation risk was used as a pretext to shut down Republican accounts. Whether you buy into that narrative or not, this rule is designed to make sure examiners cannot get involved in those kind of politically driven decisions. And I guarantee you, they don't want to. That's it. That's the take on this proposed rule. And as it gets finalized, as more comes out on it, I will have follow-ups. I will have a separate short podcast on the elimination of all the risk areas, and more to come on that down the road. As always, I appreciate you listening. I appreciate you watching. This is Mark Treichel signing off with Flying Colors.